Hello everyone, welcome back to my channel. So this video is a video that I wanted to do for a few weeks now, and it basically is related to the fact that we made a change in our strategy when it comes to our challenge of reaching 100k in realized returns. And as for those who follow the challenge, you may notice that we simply stopped using as our main focus options on stocks and start using options on ETFs that track indexes. And so this video will be about the reasons why it is better to trade options on ETFs that track indexes rather than options on stocks, in the context, of course, of the wheel strategy, because of course there might be other strategies in which stock options are better, but in this case we are focusing on the wheel, and for the wheel, that this is why, or the reasons I'm going to explain are why I believe this optimizes our strategy from the perspective of the wheel. So the first reason that I wanted to showcase is the fact that basically options on, and I'm going just to use the term ETFs because we assume that these ETFs track indexes, all right? Options on the ETFs / indexes have, and I'm going to put this in bold, have lower volatility, both historical and implied, right? And as you can see, and I'm going to show you that if you look here, for example, and I'm going to show here the QQQ, for example. If you look at the chart and look at the stats, you'll see that for the QQQ, the volatility, both historical and implied, is around the 16 and 17.8%, right? So this is a relatively low volatility, and we can go even further down in the volatility if we look for the ETF that tracks the S&P 500, the SPY. And as you can see, it has an even lower volatility between 12.4 and 13%. So you see that this gets even further down. Now, even an index such as the IWM, and keep in mind that this index, this ETF, is the ETF that tracks the Russell 2000. The Russell 2000 is an index that tracks 2,000 small cap companies, and as all of you know, small caps are by nature more volatile than mid caps, medium capitalization companies, or even large caps, large capitalization companies. And so even though we are talking about an index that follows small caps, we are talking about a historical volatility of around 20% and an implied volatility of around 20.4%. So this tells us that indexes are very stable, and this is exactly what we are looking for in the context of the wheel strategy. Whereas, for example, even if we compare this to a stock which is very, very stable, because of its size, it's a large cap such as the ExxonMobil, which was formerly the company with the biggest market capitalization in the world, all right? As you can see, it has an historical volatility of around 17.5 and an implied volatility of around 21.3. So this is a comparable level of volatility, both historical and implied, to our index, or to our ETF that tracks the index of small caps. And so, as you can see, such a stable company, but because it's a stock on a company, on a particular company, it can only rival and because of its very, very high stability, it can only rival an index that includes small caps. And because of that, as you can see here, this is something that is very important. So they have lower historical volatility. And why is that? This is due, and I'm going to do this. This is due to the fact that indexes include many companies, and the volatility of those tend to diversify, or as you may call, offset each other most of the time. And so this is and so this provides an added layer, of diversification, because the S&P 500 has 500 companies, the NASDAQ has 100, the Russell 2000 it includes 2,000 shares, so on indexes. So as you see, it makes more sense for us to trade ETFs on indexes in the context of the wheel, because as you may know, here, if we look at the payoff pattern of a short position on a put, which is something like this, it's convenient that the stock price remains, and of course knowing that this is the strike price, all right, this is the strike price, we know that it's good, and because the price when we enter the position is around here, because the put is out of the money, it's good for us that the stock remains around this price range, right? Because that allows the put to expire worthless, we keep the premium, and that's it, we get off the position. But if the stock is very, very volatile, chances are that prices will go up and down, and it's much more likely that the stock ends up in this region over here. And this will force us to buy the stock, and then, of course, as you can imagine, then we are forced to sell calls. But even so, we lose flexibility in our ability to capitalize on the money that we use to acquire the shares, because as you can imagine, and this is a pattern of a short call, if the price falls by too much, and this is the strike price, and the strike price is going to be at least, so let's put here, greater or equal to our acquisition price, right? And so if the price falls down below the acquisition price by a large margin, for example, if it goes around here, we will not be able to sell calls, because unless we put ourselves in a position in which we can lose money. And this is exactly what happened already many times this challenge, because if we look here at the Pfizer shares that we hold, and I'm going to look for them in here, look at the option chain, and if you look here, all right, for some reason this is not cooperating. Now it is. All right, if you look, this is a weekly option, and our cost of acquisition is 28.5, but because the price went down by a large margin, currently it is not available, the call that we want to sell. And so because of that, we have to stretch our maturities much further into the future in order to be able to collect some premium out of it and try to sell the shares by selling calls. And so it is much better to have low volatility underlying assets, and so that's why indexes are, because they are much more stable, they allow us to get into our objective, to fill our ambition and objective of pursuing the wheel strategy, than by using stock options. So this is the first reason. Another related reason for this is basically the fact that they have lower volatility by nature, but also options on ETFs or ETFs on indexes are much, let's put it like this, are less sensitive to what we usually call volatility events, which are usually earnings releases and guidance, dividend decisions made by company, for example, also monetary policy decisions, in this case by the Fed, the Federal Reserve Bank, which is the central bank of the United States. Also, for example, political developments. And why is this? We can see by looking at the charts that this is exactly the case. For just to give an example, and coming back to our old friend Estee Lauder, as you can see here, this was the day, October 31st, in which the earnings were released. Stock dropped around 20%, and there was a huge gap. But if we look at the S&P 500, and on October the 31st, you will see that the gap that existed was much smaller, you see. And so let's just look, for example, the case of Ford Motor Company. We already had the shares when this huge gap occurred here, and this is on July the 25th, but the SPY on July the 25th, let's just see right here where it is. As you can see, did not gap. It opened basically at the same value that it closed the previous day. Of course, it had a down day, but still, it was a day in which there were no gaps, and so the losses were much smaller than if you hold the 4 shares than the S&PX. And this was just an example of the case of the sensitivity to earning releases, the earnings guidance, because Estee Lauder in that case withdrew its earning guidance for 2025, also decided to slash the dividend. And so, as you can see, this is quite clear that the volatility events have a much lesser impact on indexes than on individual stocks. Also, when it comes to monetary policy decisions, and if we look at, for example, at the latest one, here, for example, this had a big impact, of course, but if we use our calculator, I'm pretty confident that the value of the fall, the percentage of the fall will be lower, for example, for the XP 500 than, for example, for an individual stock. And let's use this example right here. So let's use the opening let's use let's going to use also the close. So 5872.16, which was the value at which it closed, and it opened at 60.47.65 and -1. So it lost 2.9%. Let's use, for example, well, we can use Estee Lauder, for example, and let's see what it is. Or yeah, this is the one. So here, so the stock closed, let's just put it here, closed at 74.96 and opened at 77.50. All right, -1. So the stock came down by 3.3%, give or take. We can probably use another one, for example, Pfizer. Let's see. Actually, this is not a good example because, well, I don't know. We can try to see how much did it go, but it did not came down by much, especially because it came down. It had a minimum a few days earlier, but I think you get mostly the picture. So let's try, for example, here. It closed at 25.89 divided by 26.19. Right, so this had a lesser impact, 1.1%. We can try to use another ones, for example. Let's try, for example, one of the technological ones, Tesla, for example. Let's see. Right, this is the one. So let's try, for example, let's try one, for example, here. So it closed at 440.13 divided by 466.50, and if we take the one, so for example, Tesla fell by 5.7%, give or take. So as you can see, the tendency for stocks to be more sensitive to monetary policy decisions is greater than if we account for the indexes, because even the QQQ, I recall, that fell a little bit more than 3%, while Tesla fell, as you see here, 5.7%, and so this is also a difference. For example, looking at political developments, if we look here at November 5th, and we are looking here at Tesla because November 5th was the day at which the Republican candidate Donald Trump won the 2024 presidential election. As you can see here, there was a huge gap from the closing day here until the opening day here. So it jumped from 247 to 284. So this is, of course, a very, very significant step. If we look here, and it opened at 284.67, it closed the previous day. Let's see, how much did it close? It closed at 251.44. So it rose 13%. There was a gap of 13% for Tesla, but for example, if we look at the QQQ, the increase was not as big. Let's see here for the chart for the day, and for November the 5th, as you can see here, yeah, this is it. So the stock opened up at 500.56%, and it closed the previous day at 492 0.21. So this was an increase of 1.6%, which is 1.7%, which is much smaller than the increase, for example, for Tesla. If we look, for example, for let's see, for example, Estee Lauder, where is it? Estee Lauder, November the 5th. I recall that, yeah, it's not even a good example because the stock basically did not move. But if you look, for example, here at Pfizer, yeah, it came down it came up. It was a good day, but very small. But looking here, for example, at the SPY, let's see, where is November the 5th? Yeah, it gapped also, and gapped in a big way. Let's look at here at, for example, another stocks like, for example, I don't know, we can use, for example, let's see, besides Tesla, Alphabet, for example, which is right here, the November the 5th. Yeah, there is also a big gap here, and let's see how much is it. So yeah, previous day. All right, so here actually it did not move because this is November the 5th, and then it gapped. For some reason it gapped only the next day. All right, so let's see. So it opened at 173.79 and it closed the previous day at 169.74. So it was only increased at 2.3%, but I think you get the picture that indexes, because they have lower volatility overall, they are also less sensitive to also political developments. We can look also as well, for example, for the case of the war in Ukraine. If we look at a date in which Russia, the Russian Federation, decided to invade Ukraine, and we can look here at February 24. Yeah, as you can see here, the gap between the close of the previous day and the day of the invasion is significant, because the stock here closed at 127.59 and it opened the next day at 124.83. We can use another example, for example, the Tesla. And if you look back here, February 2022, here, see, yeah, another example, another gap. It closed the previous day 764 euros, $4 and it opened the next day, and it opened the next day at 700.39. So it lost $64 in between the closing of the day before the invasion and the opening of the day of the invasion. So this is also a quite significant drop. And in contrast, the indexes did not had the same behavior. Let's see here. And this is probably the last example I'm going to give, because I think this is self-explanatory. So here it opened at 4,298, and here it opened at 4,155, and it had closed the previous day 4,225. So it was basically an 80 point difference between the closing of the previous day and the opening of the day of the invasion. So it is a much smaller impact because of course we are talking about larger numbers. 80 points in between around 4,000 points is not as much as 64 points in 700, around $700. So there is a difference, a significant difference between the volatility to political developments between stocks and indexes. And so this is also another example that makes us moving towards options on ETFs and index rather than stock options. Now, another reason for this, which is also important, and it's actually more subtle, is the fact that options on ETF/indexes have available what is usually called zero DTE options. What are zero DTE options? Are options that have only let's just say that expire the same day, in the same day. And what is the main advantage of this? The lower the maturity, the time to maturity, or the smaller the the shorter to maturity, that is correct, the time to maturity, the less risk is incurred, and in case of zero DTE options, there is no overnight risk. What do I mean by overnight risk? If, for example, in the middle of the night, and of course this is an odd example, but in the middle of the night, a terrorist attack occurs in a given city in the US, with zero DTE options, or put options, should I say, put options, we are out of the position when the market closes. So the event, when the market closes, and by extension, when the terrorist act occurs as well. So this, so we are immune to that risk, and in the next day, we assuming the market plunges, we can set the strike price of our puts at a much more at a much lower level without any downside. Of course, if we are at the stage of the wheel in which we are selling calls, we are still exposed because we own shares and their price will plummet in the next day or in the day after the event. Of course, this will be a problem, but even so, as long as we are at the stage of selling the puts, this risk will not we will not be exposed to this risk, because as you can see here, and looking at the QQQ, which is the index or the ETF we are focused on, as you can see, and we are doing this at Monday morning. So the market is still in the pre-trading stage. It will only open later in the day. As you can see, we have options that will expire today. We also have options that expire tomorrow, 2 days after, the day after tomorrow, 3 days ahead of us, 4 days ahead of us, and then the weekend occurs, and we also have the weekly options here that we usually have available only for individual stocks. If you look here at Pfizer, we have the options for this weekend, all right, that expire on Friday, then the next Friday, and then the following Friday, the following Friday, the following Friday. So for individual options, for individual stocks, you have options that only expire on Friday at the end of the session, whereas for QQQ, which is the index, the ETF that tracks the Nasdaq, we have options expiring every single day at the end of the session. If you look at the SPY, the same thing happens. You have options expiring every single day at the end of the session. If you look at IWM, which is the ETF that tracks the Russell 500, same thing. You have options expiring every single day. So you are not exposed to overnight risk as long as you are selling puts, which means you don't have any shares at that particular moment in time, and so you remain fully flexible to set your puts at the strike price you want, and you have no risk if something happens overnight. It can be a terrorist attack. It could be some monetary policy decisions taken by other central bank, European Central Bank, the Bank of Japan, the BOJ, the Bank of China, for example, the Central Bank of China. It could be anything happening, and you are not exposed to that kind of risk. And so, basically, this is the most important thing. And of course, zero DTE options also have another advantage. I'm not going to give too much detail on this, because I think this can be the topic for another video, but zero DTE options also have the advantage of losing their value, their time value, much faster than longer maturity options, because of the pattern of the theta, which is the Greek that measures, which is the Greek that measures the rate at which options lose value with the passage of time. And so if I use here the paint to show you, I showed already before in another video, but I'm going to show it in here. Well, this is not the correct way to do it. Let's do it in another way. Let's use it like this, and we do it like this. And so in here we have the time, and here we have the time value, right? Time value. And assuming, for example, that the maturity of our options is here at this particular point. This is the maturity, the time at which the option matures. Now, for a put option, the pattern of the theta goes like this. It goes down and down and down and down all the way, but then as it reaches very close to maturity, it loses value very sharply in a vertical way. This is the theta of a put option. And for a call by nature has an equivalent call option has more time value, and so it will lose value faster as time goes by, but then as it reaches the maturity, it follows the same pattern. It starts to go down vertically, very sharply. Right? This is the pattern of the theta of a call. This is the difference? I will explain that in another video, but consider the fact that 0 DTE options only lose their value here. From the moment the market opens until the market closes, they are more in this zone, so they lose value much more quickly. This is 0 DTE options. Alright, 0 DTE options only lose their value very quickly. Longer dated options, they lose their value around here, so they do not lose value as quickly. And because we sell the options as the seller of the option, or the writer, as you, whatever you prefer, option, we want them to lose value, or the time value, as soon or as quickly as possible, so that they either expire worthless quickly, or we can buy them back very soon after at a much lower price. All right, and with longer dated options, the rate of loss of time value is slower, so it is more difficult. So we have to wait longer. So and let's just put it in parentheses. So assuming equal conditions, equal market conditions, we have to wait longer to either let them expire worthless or to buy them back at a much lower price and they are exposed to more potential negative events that can cause us to lose the trade, to have losses on the trade. All right, and with zero DT options, this is much less likely. All right, and so this is it. These are the main factors. Again, as I mentioned, in a future video, I will explain why there is a difference between the theta of a put and the theta of an equivalent call option. But I will explain that in another video because this video is already getting quite long. For the time being, this is it. I hope this makes it quite clear why options on indexes, on ETFs that track indexes, are much more convenient for the wheel strategy than options on stocks. If you have any questions, please leave a comment or leave that question in the comment section below. Also, feel free to like the video and subscribe to the channel. I'm also available on LinkedIn in case you need to ask me any questions or make any comments, any insights that you want to share. And yeah, I'll see you all in the next one.